Thank you. Everybody hear me okay? Thank you, Julie, and thank you, IHMC. What Julie didn't tell you, by the way, free food and a bear market go hand in hand. You get 200 people like that on a day like that. The second year I went to Pensacola and spoke to their group was right after they had their tropical storm. So I am Mr. Good Luck. So when you go out after this and you have to scrape the locusts and frogs off your cars, you'll know why. Thank you for coming tonight. What I'm going to talk about this evening is how risky is this market, and we're going to break it down in about 4 components. I'm going to talk a little bit about risk in terms of how risky I think the market is on a longer term time frame. Longer term typically being 18 to 36 months in the market, maybe even a little bit longer, and I'll tell you why I'm reasonably optimistic about stocks on even a longer time period. We'll look at short-term risk in the market over the next couple of months. I'll show you a tool that I use. I've been in this for almost 30 years, and it's the single best tool I've ever seen for giving you some idea about market risk on a short-term basis. And the beauty part of it is all it costs you is the price of a daily newspaper. Very simple to use, very cheap to get. And again, the best tool I've ever seen for trying to get some sense of market risk on a short-term basis. I'll then segue into where I think the sweet spot is in the market given risk levels. Where do I think the best opportunities are in stocks right now? And then finally, I'll get to that part that everybody always waits for when I give out stock recommendations and everybody wakes up and pens come out and paper. I've done enough of these things. I should just get up here sometime and just reel off stock tips for 40 minutes because that's all what you all want. But I'm going to make you endure about 35 minutes of hearing me out here first before we get to that. And then we'll close with some questions. So how risky is this market? Well, let's look at the long-term risk of this market. Up on the screen, I have the Dow Jones Industrial and Dow Jones Transportation Average. I wear a couple of hats. I'm CEO of Horizon Investment Services, which is a money management firm. I'm also CEO of Horizon Publishing, which publishes investment newsletters. Horizon Publishing may not mean anything to anybody in this room, but one of our flagship publications is something called Dow Theory Forecasts, which is one of the oldest investment newsletters in the country. We've been publishing that newsletter since 1946. I haven't been there since 1946, but I have been there since 1982. I'm a rarity. It's the only place I've ever been. I've been there for 28 years. Short story. My first day on the job, 1982, August 16th, Dow was 790. Second day, the Dow Jones Industrial Average went up 32 points, which doesn't sound like a lot, except it was about a 5% move. In today's market, that would be somewhere about, 600, 700 points in a single day. And from that day, my second day on the job, the market really took off, and market historians, and I look around the room, I'm not the only one here with some gray hair, so some of you probably remember the 80s and indeed the 90s, and you go back and think wistfully of all the money that you made in those 80s and 90s, and now when you realize it's all started on my second day on the job, well, you're welcome. So, my firm has been following a tool called the Dow Theory since 1946, and we use the Dow Theory to discern the market's primary trend, whether the primary trend of the market, i.e. the trend that typically lasts 18 to 24 to 36 months, is bullish or bearish. The Dow Theory is a very simple tool, and it was developed by Charles Dow, the first publisher of the Wall Street Journal in the 1890s. And that work was furthered by a fellow named William Hamilton in the early 1900s. In a nutshell, the Dow Theory looks at two things and two things only. It looks at the performance of the Dow Jones Industrial Average and Dow Jones Transportation Average, and from the movement of those two averages to each other, will tell you whether the market's primary trend is bullish or bearish. So when we are trying to make a determination in terms of the long-term risk in the market, the first thing we go to is what's the Dow Theory saying? Well, in a nutshell, what you want to see under the Dow Theory are both the Dow Jones Industrial Average and Dow Jones Transportation Average basically mimic each other in their movements in terms of direction. Obviously, you want the direction to be up. A bear market under the Dow Theory is when you have both the Dow Jones Industrials and Transports going lower in sync and making a series of lower lows. So what have we had since really March of 2009? I mean, eerily, really, you've seen almost in lockstep of movement in the Dow Jones Industrial Average and the Dow Jones Transportation Average, where it has made continuing series of higher highs. There have been periodic pullbacks along the way. We could see in mid-2010 there was a pullback in the Dow. We had a little bit of a blip earlier this year. If you go back here in the transports again in 2010, kind of mimicking that pullback. But any pullbacks up to this point since March of 2009 have been fairly contained. The Dow Theory does a nice job of defining these pullbacks. In a sense, a pullback within a bull market typically lasts anywhere from 3 weeks to 3 months and retraces about 1/3 to 2/3 of this previous move. So we had one of those pullbacks here. We had one of those pullbacks here. The good news was the market bottomed, came back, and then went above its previous high in both cases. So in a nutshell, what we have under the Dow Theory is if you're a Dow theorist, you can't look at these markets and come up with any other conclusion other than the primary trend of this market is bullish. Again, you've had higher highs in the industrials, and you've had higher lows. The pullbacks have been contained, and every pullback has been followed by a resumption of the upward trend. So when I take a step back and look at the market and try to figure out what the primary trend, the trend that typically lasts a long time, 12, 18, 36 months or longer, I think it's a bull market. Now, there's a lot of noise in this market, and there's always a lot of noise in markets. And, you know, we have had opportunities when the markets have pulled back. Pullbacks are part and parcel of all bull markets. And the purpose of pullbacks are what? To scare the heck out of you, really. I mean, that's what a pullback in a bull market is supposed to do. It's supposed to scare the heck out of you. It's supposed to strip out some of the speculative froth that is built up on the previous advance. It's to restore value, and you need those to sustain long-term bull markets. So, you know, pullbacks are part and parcel of all bull markets. We typically don't try to trade those too much because, again, you know, the danger of trying to trade 5 to 8% pullbacks in the market, if you think there are only going to be 5 to 8% pullbacks in a market, that's tough stuff. You might get it right a time or two, but what happens when you're wrong, you're going to undo all the times that you were right, and you're going to be sitting there holding a ton of cash when the market takes off. So don't be too concerned if you see markets pull back. And when I look at the shorter-term risk in the market, we're probably at a point, maybe not quite, but getting to a point where you would expect some pullback in the market on a shorter-term basis, and I'll show you why in a moment. But right now, again, we just had the Dow Jones Industrial Average go to a new all-time, or not an all-time high, but a new 2.5-year high at the end of April. We just had the Dow Jones Transportation Average go to, I believe it was a new all-time high a couple of days ago. So, you know, there's been a lot in the news, a lot of movement, commodity prices flying all over the place. You're having stock prices that seem like they're flying all over the place. Fact of the matter is, when we look at what we think really matters, when you're trying to get some sense of what's going on in the market, from a longer-term primary trend standpoint, market's firmly bullish, in our opinion. So I would keep that in mind as you consider how you should allocate your portfolio. Right now, for example, in our client portfolios, they give us the ability to be 100% or a near 100% invested in stocks based on their investment objective. We're about 90 to 92% invested. So we got plenty of skin in the game. We're holding a little bit out, and I'll show you why in a moment. We're holding a little bit out, but we still have a fair amount of, we have 9 out of every $10 in those portfolios are in stocks right now. And one of the main reasons is A, we're seeing opportunities, and B, the primary trend is still bullish under the Dow Theory. Now, let's look at the shorter term risk level for a moment. What I have up on the screen now, no, this wasn't everyone's EKG during 2008, including me. This is a look at what we call the intermediate potential risk indicator, okay? This looks like a lot of gobbledygook and a long-winded name. It looks at one data point and one data point only to chart this. That data point is the percentage of stocks on the New York Stock Exchange that trade above their 200-day moving average. Okay, the percentage of stocks on the New York Stock Exchange that trade above their 200-day moving average. Well, some of you are probably thinking, well, who cares about that? Well, this chart right here, this is worth the trip for you. Trust me on that. This is going to be worth your trip. It's the single best tool I've ever seen for giving me some perspective. And I use that word a lot because I think at the end of the day as an investor, that's about the best we can do, is get some perspective to try to bring in a variety of tools and get some idea, some perspective, some relative perspective on what's going on in terms of market risk. This tool's really good. Looks at the percentage of stocks on the New York Stock Exchange that trade above their 200-day moving average. Why does that matter? Well, I'm a believer in this mathematical concept of reversion to the mean. I got my MBA from University of Chicago. I'm kind of a numbers guy that way. And I kind of believe in that concept of reversion to the mean. Reversion to the mean says that in the short run, things can go to extremes. But over time, things will tend to migrate to kind of a steady state, a golden mean, an equilibrium, if you will. Think weather patterns, okay? In the short run, you can have weather patterns all over the place. You can have snowstorms, ice storms, hurricanes, tornadoes. But the weather typically doesn't remain at those points. Why? It takes too much energy to generate those extremes. Once the energy dissipates, you get back into more of kind of an equilibrium level. Think human emotions. You know, births and deaths and job losses and new jobs and so forth. And our emotions can spike, but hopefully we don't live at those extremes. Why? We'd be exhausted. It takes too much energy. And over time, as that energy dissipates, we tend to lead our lives at some sort of equilibrium level. Now, my equilibrium level may not be the same as yours, but we tend to kind of exist at some steady state. I think there's an element of reversion to the mean in stock prices, and we've seen it time and again in the history of the stock market. 2008. That was all about selling pressure. Boom, sell, sell. If it moves, sell it. If it moves, sell it. If I can sell it, I'm selling it. Because I got margin calls, I got redemptions. Sell, sell, sell. Well, at some point, the tremendous amount of selling energy subsided. Where did it subside? Well, if you go back, it subsided really around March of 2009, and then stocks started to migrate back. When you look at the percentage of stocks, when you look at a stock's 200-day moving average, to me, that represents a reasonable proxy for a stock's equilibrium price range. It's not perfect, but if you're trying to get some sense of an equilibrium level for a stock price, a 200-day moving average is a reasonable proxy. Why? Well, to get a 200-day moving average for a stock, what do you have to do? Well, you have to take 200 trading days. You take the average of those 200 trading days, the prices of those 200 trading days, and that's your point in the line. To get the next point, you drop a day, you add a day, take the average, and so on. So when you're looking at a stock's 200-day moving average, you're looking at a pretty long period of time, probably over multiple cycles for that company, okay? So if you're trying to get some sense of where a stock's equilibrium price range is, a 200-day moving average works pretty well. Again, it's not perfect, but I think it's a pretty good proxy for that. Now, you don't have to have an equilibrium range. Most stock price, the 200-day moving average is not a flat line. Typically, they will tend to trend higher, the last 10 years being an exception. Why? Historically, stock prices do tend to trend higher. I know maybe that doesn't quite feel that way when you look at where you were 10 years ago and where you were today, but typically that's what happens. So you don't have to see a flat line, but to get some idea of this reversion to the mean, we look at 200-day moving averages, and then we say, okay, what's the percentage of stocks on the New York Stock Exchange that are trading above that? If you have lots and lots and lots of stocks trading above that equilibrium level, reversion to the mean says at some point, maybe not today, maybe not tomorrow, but at some point, to have some perspective, that word again, you would expect stocks to start to drift back down to that 200-day moving average. Likewise, when you have very, very few stocks that are trading above that, and you have a lot of stocks that are trading below their 200-day moving average, you would expect at some point that stocks will migrate back upward to that 200-day moving average. So it's a proxy for giving you some sense of just to extreme stocks have moved relative to this equilibrium level in the short run. And again, this tool typically works well for kind of 2 to 3 month risk patterns when you're trying to assess risk over 2 to 3 months. So let's look at this chart for a minute. My firm's been using this since 1989. And again, single best tool I've ever seen for giving me some sense of risk in the market. Let's go back to the fall of 2001. the percentage of stocks on the New York Stock Exchange in the fall of 2001 fell down to about 19 to 20%. At that point, that was the lowest we had ever seen that percentage fall. Obviously, right there, stocks were way out of favor, okay? People didn't want to own them. Reversion to the mean said they were so far out of favor, in fact, you would expect at some point some bounce back. Anybody recall what happened in the fall of 2001 that might have driven stock prices down like that? Yeah, it was 9/11. Okay, and if you go back to 9/11, what happened? We had the event. Markets were closed. When the markets opened up, what happened? So if you're trying to get some sense of just how out of favor stocks were at that time, and you can chart this in real time. I'll show you where you can get the data point in a moment. So you knew on that, right after 9/11 that this had fallen all the way down to 19 to 20%. Historically, it had never gotten that low. So you knew at the time, geez, stocks seem pretty cheap from a risk standpoint in the short run. Now, rationally knowing that and doing something about it oftentimes are two different things. Because it's obviously very difficult for most people to kind of muster up the courage to be buying stock after an event like that. But, as we all kind of intuitively know, you may not get the bottom, and I'll show you in a moment you didn't get the bottom, at least for probably another 12 months. But at least you have some perspective that you're buying stocks or adding to your positions at prices typically that are probably going to pay off for you in the future. Maybe not the next day or the day after that, but at least you have some idea you're buying pretty good value at that point. So, what happened? Well, had you bought here, you would have probably felt pretty good because what happened in early 2002, the market had a pretty nice little run. And then what happened? Boom. It really fell. So right here, you're thinking, yeah, that Carlson guy's an idiot. I listened to him. I bought down here. And now I'm back down here again. The good thing was, though, you might have felt like an idiot, and you might have been early, but boy, you were awfully glad you did when it took off in 03, 04, 05, 06, 07, and into early 08. Those were all 03, 04, 05, 06, 07 were all up years for the market, some of them pretty nice years. So you were early had you bought down here based on the fact that risk was pretty low historically. You felt a little bit of pain in 2002, but boy, you're awfully glad you did. And I think that points us to a significant point. None of us are ever going to call, maybe you will. I never have, call an exact bottom in terms of markets like that. It's very difficult. The best you can do is get some perspective and say, you know what, I don't know if this thing is going lower, but I know it's pretty cheap right now. And if there's some way that you have built into your investment process to make investments, that's a good thing. That's why I'm a big proponent, and I'll talk a little bit later about dividend reinvestment plans. And one of the real unsung benefits of dividend reinvestment plans, in my mind, is the part that everybody overlooks. Well, geez, you reinvest dividends, big deal. Well, I'll tell you what, in market environments like this, probably the only buying a lot of people are doing, because they can't muster up the courage to buy, is if they are reinvesting dividends to buy additional shares at that point. That's the beauty of the whole 401k investing, where that money's coming out of your paycheck and it's coming out every month or every week or whatever you're getting paid, and it's forcing you, when your emotions don't want to do it, it's forcing you to kind of do the right thing. Again, the right thing turned out 03, 04, 05, 06, 07. You didn't get it right away, but you were awfully glad you did. So let's fast forward now to, I know it's painful, 2008. 2008 into 2009. If you want to get a sense of just how out of favor stocks were, okay? At the end of 08, the beginning of 09, the percentage of stocks on the New York Stock Exchange trading above their 200-day moving average fell to 2%. Now, obviously, you couldn't go much lower than that, right? 98 out of 100 stocks on the New York Stock Exchange were trading below their 200-day moving average. Now, some of you, rightly, are probably saying, well, you know what, Chuck? Geez, when it got down to 20 in early 08, and again here in mid-08, if you were buying in there, boy, you felt like a dummy, right? because then the market just tanked going into 08 or 09. And you know what? You're right. You were early here. But again, had you bought anywhere in here, and if you were fortunate enough to have bought down in here, what happened? Well, you'd be pretty darn glad you did, given what happened in 09, 2010, so far this year. So again, this is not necessarily a tool that is going to spike bottoms for you and spike tops for you. Because, as we have seen, things can kind of stay at extremes longer than you think. But at some point, if you are at an extreme on the upside or extreme on the downside, history says things will tend to turn your way. If on the low side, probably not a bad time to be buying stocks. If you're at the extremes on the upper end, probably not a bad time to, if not trim back your investments, maybe not be aggressively investing at that point in time. So, where are we right now? What is this tool saying right now? Well, when I updated this chart, it was about 3 days ago. So I looked today, going into today, what the percentage was, and it was 71%. So it's still right around this level. So right now, today, 71% of the stocks in the New York Stock Exchange are trading above their 200-day moving average, which gets you into this area that we have kind of classified as higher risk, anything above 70%. Now, we're just at 70%. And this tool, like most tools, tends to work best when you're at the extremes. 70%, you can make an argument, maybe it's at the extreme. I typically like to make judgments more up in this area, the same here. Below 40%, we classify as lower risk, but really at the extremes is kind of when you want to be making more of your bets. So right now in today's market, we're at 70%. Maybe we are at the peak, near-term peak. Market's been churning around a little bit. It's been kind of sloppy the last few weeks. So maybe we are at kind of a near-term peak in the market here. I don't think so. I think we need to go a little bit higher. I'm kind of thinking we need to go above 13,000. Right now we're about, I think the market ended today at about 12.6, almost 12.7, the Dow, speaking of Dow Jones Industrial Average. So, you know, I think at 13.1, you're going to see this up in that 80s range and that starting to get to a point where I would think you would expect to see some pullback at some point. So, longer term, Dow Theory is bullish. Shorter term, we're getting to a point where you would expect some pullback in the market. Now again, the Dow Theory is pretty clear. If we get a pullback like that, we're going to assume that it's still a pullback within a bull market because the last major signal under the Dow Theory was bullish. So, what kind of pullback would you expect to happen? Well, let's see if I'm right. We get to say 13.1. We've had a pretty big move in the market, you know, maybe 1,500 points to 2,000 points since the last pullback. So, if the Dow Theory says in 3 weeks to 3 months that market can pull back 1/3 to 2/3, if we use 1,500 points as kind of our benchmark, that could be a pullback of 1,000 points. So, would it surprise me if we got to about 13.1? 13.1 and then pulled back to somewhere around 11.8 to 12,000? No, that wouldn't surprise me. That would be a pretty traditional pullback within a bull market. Now, what are pullbacks supposed to do? Scare the heck out of you. Would a pullback of 1,000 points scare the heck out of you? Yeah, you know, it's interesting, and one of the reasons why I think this pullback will just be a pullback within a bull market, not the beginning of a bear market when it happens is, I've been doing this for almost 30 years, and typically investor sentiment after you've had a run like this would be normally pretty ebullient. People would be jazzed about stocks. They would be sucked in big time. You've had a market that's basically doubled from this low in March. It's gone up 100%, roughly 100%. You know, historically, you would have people just dying to buy stocks. I'm not seeing that. What I get are calls, the market goes down 150 points in a day, and I get calls from people panicking. And the panic is this line. We finally got back to where we were, and I don't want to lose it. So what do you think? Well, that kind of sentiment to me, for a longer-term perspective, just indicates to me that we're still not at a point where there's just the insane bullishness that you typically really see with significant market tops. I think people, you know, and I don't want to answer for people in this room, but my guess, if I had to, is that we're all still pretty nervous about stocks. And that's interesting after a market that's done what it's done. I mean, if you look at inflows, for example, to equity mutual funds versus bond funds, you're still getting an awful lot of money going into bonds. And you had a tremendous amount of money going into bonds in 2009 and 2010, much more so than going into stocks. So people are still putting money, they're begrudgingly putting money into stocks here, which is one reason why I think any pullback here is going to be a pullback within a bull market, fairly contained. I think it will, after you have that pullback, will resume and go above the previous high that's established in here, say 13.1. So, longer term perspective, I think, is still bullish. Shorter term, we're getting to a point where you might expect some pullback in the market. What would be the magnitude of that pullback? Maybe worst case, you could see a pullback of 1,000 to 1,200 points back to around that 11,800, 12,000 level. Now, I promised you I would tell you where you could get this indicator. The percentage of stocks on the New York Stock Exchange is provided every day in a newspaper called Investors Business Daily. Okay? I don't work for Investors Business Daily. You don't even know I exist. I don't make anything from Investors Business Daily. But it's the only place I've ever found where you can get this, and you can get it every day in Investors Business Daily. They provide, this is a snapshot of the page B2, B as in boy, page B2 of Investors Business Daily. On that page, 4 out of the 5 days, not Monday, they make you fish around in the newspaper on Monday, but Tuesday through Friday, on page B2, you'll see a series of charts on that page. And one of the charts is going to be the NYSE composite. Every day on that NYSE composite, in the same place where I have circled, that's my circle, by the way. IBD doesn't go that far for you to help you out. You can find the percentage of stocks that are trading above their 200-day moving average. So again, for the price of a daily newspaper, anybody in this room can track that, and you can plot it and take a look and see. And again, for my money, it's the best thing I've ever seen for giving me some perspective on short-term market risk. And again, I think where that comes into play is, you know, in the shorter term, if you're somebody who's investing and you see the market where it is now, maybe you're not pulling aggressively money out of the market, but maybe you want to hold off making additional investments. Maybe if you feel overexposed to stocks because you are heavy in stocks and your portfolio's had a nice run, maybe it is a reason to pull some money off the table. Again, I think you're going to have to see that percentage probably get up closer to 80% before we get that significant pullback. I have this chart up here, or table, to kind of give further credence to why I think there's the opportunity for stocks to have a longer-term bullish run than most people think. I'm probably in the minority of that. And you know, you don't have to go too far to turn on CNBC or pick up the paper, and you're going to find 5 people that tell me that I'm crazy. And I'm not talking about a 1990s bull market run. You know, anybody want to guess what stocks did on average in the 1990s per year? It was 18%. To put that in something that helps, you know, the rule of 72 that you're all familiar with, it says basically if you divide something into 72, it'll tell you how many years it takes to double. So if you've got 18 into 72, that's 4. So at 18% a year, your money's doubling every 4 years. So think about that in the decade of the 1990s, okay? Your money doubled if you just basically had an index fund and you were matching the market. Your money doubled in 4 years. It doubled again in 4 years, and then it went up 50% in the remaining 2 years, okay? That's pretty good, wasn't it? I don't think we're getting at that, unfortunately. But I do believe we have the potential to get back to more of markets that of a longer-term average annual return, which in the stock market going back to 1926 is somewhere around 8 to 9% per year. Now, the market may have averaged 8 to 9% a year since 1926. Rarely does the market ever go up 8 to 9% a year. It'll go up 15, down 2, up 20, down 6. But on average, I think we have the ability for equities to get back to a 7, 8, 9% on average per year over the next 5 years. One of the reasons for that is this. Toward the end of last year, during a time when you had a lot of investors still really rabid about the bond market, these blue chip companies, and there were more, were issuing debt, okay? Now, Microsoft has more money than it knows what to do with. So why would they issue debt? Well, the short answer is because they could. The second answer is when you see all these stories about all the money that these corporations have, and truth be told, corporate America right now is sitting on a record level of cash. But where is a lot of that cash? It's overseas. And are those companies really wanting to bring it back? No, they're not, because of tax reasons. So Microsoft was probably figuring, you know what, I can issue debt, I can do it at an interest rate that's insanely low. Again, all four of these companies issued bonds, 3-year bonds, okay? And there were some pretty big bond offerings here. I think IBM did $1.5 billion. Microsoft, I think, did over $1 billion. Coke, Walmart, big bond offerings. So there was plenty of appetite for these bonds. Look what these bonds were yielding. So you had investors, just to kind of frame this, you had investors that were willing to loan money to Microsoft at an interest rate of less than 1% and basically tie that up for 3 years to get that robust interest rate of less than 1%. Why were they willing to do that? Well, 2 reasons. Because these people were confusing Microsoft with their money market at their bank. Because what were you going to get at your bank on that? Nothing. Also, you have a pretty good assurance you're going to get your money back in 3 years. So that's the type of risk aversion that was going on right here. You had an investor that was willing to loan Microsoft money at less than 1%, collect that whopping 1% coupon rate, which, by the way, if the bond is held outside of a tax-preferred account, they're going to pay full tax on it at their ordinary tax rate, right? And there's no chance that that interest rate's ever going to go higher. Okay, you're locked in. Versus the same investor could have gone to Microsoft and been an owner of the company. Not a loaner, but an owner. At the time, in November, Microsoft was paying a dividend yield that was almost 3 times as much as what they were getting on the bond. Furthermore, the dividends are what? They're tax preferenced. Your max rate on the dividend is going to be 15%. That's not the case here. Plus, what can happen to that dividend that can't happen to this interest rate? The coupon rate, and go up. Plus, maybe Microsoft stock even goes up. So, now I understand, a little bit different risk profiles between the bonds and the stock. But still, at the end of the day, you had this happening when people could have been doing this. And by the way, if you want to know why some of these companies issued debt, what were they doing with that debt in some cases? They were buying back stock. Okay? Now you can see why they're doing it. Here, put your chief financial officer cap on. What's my cost of stock equity capital? It's a dividend because I got to pay dividends on that. What's my cost of my debt? That. Doesn't it make sense? Let's issue some debt, take that money, buy back stock, and I've just reduced my cost of capital pretty dramatically. So that's why you see companies doing stuff like that when they seemingly have a ton of cash already. And then companies sometimes will do stuff that you kind of wish they didn't, or you kind of cringe, like what Microsoft is doing. Yeah, that doesn't feel right to me. I'd rather they be doing what Intel's doing with their surplus cash. Intel just raised their dividend. It's the second time they raised their dividend in 6 months, but that's kind of another story. So anyway, when I was looking at this happening last year in the fall, and I was seeing this and seeing this, to me it was just shining a spotlight that said, you know what, game over for bonds. And if you're thinking bonds versus stocks in terms of, and again, a lot of times that's why you'll see a stock market go up. Why? Because there aren't really attractive alternatives. And when I saw this kind of risk aversion going on, a risk aversion which it wasn't sustainable, to me it just really shined a spotlight that stocks are off pretty good value. And I think this is one reason why I think you're going to continue to see, albeit with pullbacks, stocks continuing to do relatively well over the next 12, 24, 36, 48, 60 months. I think, again, over the next 5 years, you could get back to that 7, 8, 9%. You're going to have pullbacks. And again, I'm sure many of you during the Q&A, you're going to lay on me, don't you look out the window? Don't you see what's going on in the political environment? Don't you see what's going on in the unemployment environment? All that stuff, and we can talk about that. But remember, all that stuff's already, QE2 is, going to be done at the end of June, and that's bad. Well, everybody in this room knows QE2 is going to be done in June, right? So the market knows it too. I mean, it's the most telegraphed event in the history of the Fed. I mean, so, is that going to have all these dramatic ramifications? Well, I kind of think it's like Prego. It's already built in, it's in there, okay? So, this is one of the things I think you're going to have a market environment that can go a little bit better. Now, where do I think is a sweet spot in this market right now? Well, I think one of the sweet spots in this market are dividend-paying, kind of large-cap dividend-paying stocks. When you look at where the market, and again, this is a song a lot of people have been singing, including us, and we've been singing it for 12, 24 months, and so far, our singing's been off key. It's really been small-cap stocks that have really led the way here. But I think you're starting to see it now, actually. You're starting to see some of the defensive stocks starting to do a little bit better. We're seeing an awful lot of healthcare stocks, for example, starting to bubble up in our process and scoring well. You're starting to see utility stocks starting to score very well and starting to produce better returns. So you're starting to see that shift, I think, into large dividend-paying stocks. And I think that's a shift that's going to continue. What we do in that world is try to combine two things when we're picking dividend-paying stocks. One, we want to focus on the overall investment quality of the company. And two, we want to focus on that dividend aspect of the company and really analyze that dividend in terms of its safety, growth potential, et cetera. And we want to marry those two. Too often, investors that invest in dividends, they're not dividend investing. They're yield investing. So they're looking at the highest yields and they're buying those. And truth be told, that strategy hasn't worked too badly in the last 2, 3, 4 years. I don't think it's going to work as well going forward. I think that game's kind of over. We think the sweet spot in dividend investing are kind of those companies that have dividend yields in the 2 to 4% range. You're going to get 5 to 10% dividend growth, and you're going to get a reasonable level of appreciation. And that combination, I think, is where the winning is going to be. So what we do is we analyze the overall quality of the investment using my firm's Quadrix system. In a nutshell, we have a proprietary model that looks at more than 80 different variables for companies, and we rank those variables and come up with a ranking for that stock. And we score them from 0 to 100. So we take our Quadrix model, and our model we've been using since 2000, and the highest scoring stocks in our model tend to do pretty well, not in every market period, but over time, for example, the stocks rated 80 and above in the top quintile, which is this dark blue, have handily outperformed those in the second, third, fourth, fifth quintile. So pretty good track record of earmarking those stocks that typically tend to do pretty well. Again, not every market environment, but across a period of time, we have a lot of confidence in our Quadrix model. So we tend to take those stocks that score well in Quadrix and marry them with stocks that have really good dividend scores based on some things we use, one of them being what I call the BSD formula. I wrote a book that came out last year called The Little Book of Big Dividends. It was part of John Wiley's Little Book series. And in there I talk a lot about this BSD formula. BSD stands for Big Safe Dividends. Thank you. Very clever. What we did was we came up with a formula to really give a ranking of a stock's dividend, both its safety and its growth potential. And here are the 10 metrics that go into that. I'm not going to bore you going into all these, but these are basically things that my firm feels are relevant when you're looking at dividend-paying stocks, assessing the safety of the dividend, the growth potential of the dividend, and so forth. So what we do is take this formula, stocks that score well in this formula. In a minute, I'm going to tell you where you can find BSD scores for all the dividend-paying stocks on the S&P 1500, as well as Quadrix scores for all the dividend-paying stocks on the S&P 1500, and it's for free at a website we have. So here are some attractive dividend investments right now. These are stocks that score well in our Quadrix model that also score well in our BSD formula. So this is where, wake up now. This is stocks. So here are some ideas for stocks. Again, these are stocks, the common thread typically yields 1.5% to 2% on the low end, 4%, 5% on the high end. Dividend growth, I would expect in the 5 to 10% range on an annual basis, and at least market appreciation, okay? couple of my favorites. I'm a big fan of Intel. The company continues to surprise Wall Street. I like the dividends that it's paying off right now. It's yielding about 3.5%. I'm a big fan of CSX. It's had a pretty good run, the railroad giant. CSX is going to be splitting its stock 3-for-1 in mid-June. Boy, remember when stocks actually used to split? Yeah, boy, I know, they were an endangered species, weren't they? Well, they're splitting in June 15th, 3-for-1. That's one I particularly like. If you want something that's a little saucy, Brookfield Infrastructure Partners is a limited partnership that was spun off by a company called Brookfield Asset Management, which is a Canadian it's a Canadian company that owns real assets. They own a lot of foreign utilities, they own real estate, they own a lot of stuff, and they spun off this Infrastructure Partners. I personally own that. I owned Brookfield Asset Management, and they spun this off. Yields in that 4 to 5% range. It's a master limited partnership, so you do get a K1 with it to complicate your life or your accountant's life. But those are, it's an interesting stock. So here are some ideas for investors out there that are looking for some cash flow, looking for dividend growth, and they don't want to necessarily sacrifice appreciation on that. Here are some foreign companies that I think are interesting from a dividend perspective as well. All 5 of these companies, and I have the country that they're located in, all 5 of these trade on the New York Stock Exchange. They trade as what are called ADRs, American Depository Receipts. Foreign companies, you can buy these just like you buy any U.S. stock on the New York Stock Exchange. Some interesting names here. I don't know if many of you are familiar with Novo Nordisk, but I pretty well can guarantee you that there are a number of people in this room that use their products. Novo Nordisk is the world's largest provider of diabetes treatment. Okay? It's a great company. It's always, it's a little pricey right now. It'd be nice if it backed off, maybe about 5%, 10%. But I've been a big fan of that stock for a long time. It's a good company. Fresenius Medical, dialysis, kidney dialysis. China Mobile's the largest mobile telecom company in the world in terms of subscribers. Smith & Nephew is, and there may be people in this room as well, Smith & Nephew, they're a big orthopedic implant company. Knees and hips and shoulders. There's nobody in here that needs that, right? And Novartis, the Swiss drug company. One last point I want to make about these stocks is all of these stocks can be bought directly from the company. You don't need to go through a stockbroker. There are programs out there, and I write a newsletter on this called The Drip Investor, that talks about stocks, both U.S. and international, that allow anybody in this room to buy the stock directly from the company. The way you buy it is basically these companies have toll-free numbers. You call the toll-free number, they send you out an application and an enrollment form. You read it to learn all the details of the plan. What's the minimum amount I can invest? What's the maximum? Are there fees? And so forth. You fill out the enrollment form, cut your check. In many cases, all these companies right here, the minimum to get started is $500 or less. And they'll buy full and fractional shares for you. So if you don't have enough money to buy a full share of stock, they'll buy a fractional. They're great plans for introducing kids to investing. There are about 300 foreign companies that have these plans, and these plans allow you to make even that initial investment directly. On the U.S. side, Aflac has a direct purchase plan. You can make your initial investment directly. Aflac, the insurance company with, the aggravating duck, who's got a new voice now. Chevron, you can buy direct. CSX, you can buy direct. IBM, Intel, Microsoft. All of those companies, you can make even your initial investment directly from the company, your first share in every share. After you make that, if you want to make subsequent investments, you can. In many cases, the minimum is $50 or less. You can have the dividends reinvested for you. There are plans out there. I don't have Exxon up here. That's another stock we like and probably could have fit on here pretty well. Exxon's direct purchase plan has an IRA option built into it. So you can invest directly with Exxon. Minimum initial investment's $250. You can have that money put into an IRA for you Exxon doesn't charge you a penny in commission to buy the stock. Once you've made that $250 investment, subsequent investments can be as little as $50. Now, some of you may be thinking, well, wait, Exxon's trading for $85, $86. That's right. So if you invest $50, you're going to get a fractional share, and that fractional share is entitled to a fractional part of the dividend. So it's a very easy, low-cost way to build portfolios in individual stocks and to do it for kids. Finally, this is a copy of the book that I have. This website, bigsafedividends.com, is the website I was telling you about. Everybody in this room can go to the website. It's free. And on that website, we list all the dividend-paying stocks on the Standard & Poor's 1500 index. And we show you what their latest, and we update it on a weekly basis. We show you what their overall quadric score is and their BSD score. And both scores are 0 to 100, with 100 being the best. And you can see that, and we update it on a weekly basis. Also, if you're interested to learn more about dividend reinvestment, to get a list of those companies that allow you, with phone numbers, that allow anybody to make the initial shares purchase directly, you can get them off my website. Again, you can get it for free. The website is www.dripinvestor.com. Dripinvestor.com, www.bigsafedividends.com. And then finally, if anyone's interested in learning more about Horizon Investment Services, our money management firm, here's contact information. I'll get to the Q&A first, but I brought 2 copies of my book, and now I'm going to ask you a question before you ask me a question. I will give copies to you. Raise your hand. Don't shout out. By the way, these are signed, so the value on eBay is going to be through the roof. So, we're talking about dividends. We're talking about the Dow Jones Industrial Average. Right now, raise your hand. Tell me the highest yielding stock on the Dow Jones Industrial Average as of today. The highest yielding stock in the Dow Jones Industrial Average today. Raise your hand. If you get it, you get a copy of the book. Yes, sir. Verizon, close. They're second. Well, see, no, yes, sir. No. Yes. Google? No, Google is not in the Dow. Yes, sir. No, Berkshire Hathaway is not in the Dow Jones Industrial Average. Altria is not anymore in the Altria is not in. Yes, in the back. Exelon, the utility company? Yep. No, they're not in the Dow Jones Industrial Average. Exxon is. Did anybody hear what this gentleman said down there? AT&T, right there. Here you go. Here you go, sir. And I've got one more book. This one's going to be a little harder. I wrote a book a few years ago that looked at a different way to do the Dogs of the Dow strategy. Dogs of the Dow strategy is you buy the 10 highest yielding stocks in the Dow and hold them. I always thought that had its flaws, so I wrote a book that talked about buying the worst performing stocks in the Dow one year and how they tend to do, on average, better the next year. Sometimes it works. It works a lot of the time. It hasn't worked so well this year. But who can tell me, over the last 12 months, the worst performing stock in the Dow Jones Industrial Average over the last 12 months? You have 30 chances. I'm sorry. Who? Yeah, yes, sir. Merck? No. Chrysler, thankfully, is not in the Dow Jones Industrial Average. I'm sorry, sir. Yes, in the back. Who? BP is not in the Dow. This one, don't think of a quintessential Dow stock here. It's a fairly new member. In fact, I think it's the newest member of the Dow. Okay? Now you. All right, I'll give you since you. Yes. Cisco is correct. Cisco is the worst performing stock in the Dow. And with that, I'll throw it open for your questions. Does anybody have any questions? Yes.
What's with Cisco?
I'll repeat the. Is that if? Yeah, the question was, what's up with Cisco?
What's up with Cisco? And the other thing is it possible for one person to create a flash crash like happened to us?
Okay, let me take the first question first. I know something about that. The second one, I'm not so sure. Cisco is they're underperforming Wall Street's expectations. I mean, you know, the investment game is as much about expectations as it is absolute numbers, and you see it all the time. You know, you'll see one of your companies that you have report earnings that are up 40%, and the stock goes down 8%, and you're sitting there scratching your head going, this doesn't make any sense. Well, the reason was that performance didn't match or beat what Wall Street was expecting. And so it's all about expectations, and Cisco has been a continually underperforming Wall Street's expectations, and they just did it here recently. Yesterday, I guess. They came out with earnings. Their projections were below what was expected, and the stock consequently is in the doghouse right now. I mean, it's become what they call a show-me stock. And Cisco's going to have to come out and have a couple of quarters where they beat expectations again to start to get people to really start to buy the stock. Now, it may be a screaming buy. My system that buys the worst performing stock in the Dow over the last 12 months because of mean reversion would tell you that Cisco's probably not a bad idea for value over the next 12 to 18 months. Over the next 2 months is probably a different story. To answer your second question about the flash crash, can one person cause that? I have my doubts. The thing that bothers me about the flash crash is nobody really knows what caused it. And, you know, so if nobody really knows what caused it, could that happen again? I think we had a flash crash. I think it happened in the commodities market the other day. So I don't think one person can cause it. You can have a number of things start to happen and then everything feeds off that, but I don't think it can happen with just one person. Yes, next question.
You select first.
Yes, sir.
In your opinion, what is the likelihood of the U.S. dollar losing its status as the currency of reserve for the world? And what effect would that have?
Call me crazy, but I'm kind of a bull on the U.S. dollar right now. I think the U.S. dollar, obviously it's like it'll have swings, and I think we're now in a period where you're going to start to see it swing back up. I'm not of the opinion that I still think we're the straw that stirs the drink, quite honestly. And there's a lot of talk that that's not going to be the case. But when you look at some of the so-called people that are going to take the lead, I think there are problems there too. You know, I think everybody points to China, and yeah, China's this great growth opportunity. But you know, when I look at the end of the day, what drives stock prices are three things. You know, there's a lot of noise around these three things, but at the end of the day, it's three things. It's corporate profits, it's inflation, and it's interest rates. Corporate profit, and remember that, because a lot of stuff gets twisted in there, but it's corporate profits, interest rates, and inflation. And when people go back, you know, going back to in 2009, when people are going, I don't understand how in the world stocks are going up in 2009. You got unemployment at this and that. But what happened was, think about it. Corporate profits, what were they doing? They were beating expectations. Interest rates are low. And what does that mean? Well, when interest rates are really low, they typically don't provide much competition in terms of other investments for stocks. And finally, if inflation is moderate or under control, that helps P/E ratios rise, okay? So inflation was low, interest rates were low, and corporate profits were beating expectations. They beat them in 2010. If you want to know why stocks are going up now, because they're continuing to beat expectations. I think, getting back to your thing, you know, I think China, if you look at what's happening in the BRIC countries right now, Brazil, Russia, India, China, big growth, but when you look at inflation, they have, I think, much more of a problem in inflation. And again, people look at me like, well, you're insane. We've got inflation here. I don't hit the panic button on inflation until I see wage inflation. And I think there's just too much slack in the labor market to do that. They don't have that over in China and Russia. Their wages are going up, and they're going to go up rapidly. So I think that story is a tough one. You know, I think at the last IHMC meeting that somebody asked me about 2 years ago, if you had a gun to your head, would you buy international, would you buy U.S.? At that time, I'd buy U.S., and I'd still buy U.S. if I had those only two choices. So I guess to answer your question, I'm not in that camp that the dollar is just going to wither up and blow away. And I think you're going to see the dollar make a pretty good run here, actually, over the next 3 months. Another question? Yes, sir.
What do you think all this talk going on about? What do you think that all this talk about the adjusting the budget and getting it increased from 14.3 trillion to, or whatever it is, in the government now, what's it going to do with the debt ceiling? How's that going to affect all this?
I kind of take a broader view of that, and again, I get back to the comment I made about expectations and not absolute numbers. The absolute numbers are frightening, but what Wall Street, I think, is looking at is the trend. And you know, whether you think this president has been a great president or the worst president in the history of mankind, the one thing you really have to give him his due for, he has re-energized people back into the process and thinking about what's going on. And you know, talk is cheap. I realize that in politics, and we're going to get a taste of that. But if the trend has shifted, if there's been a pivot point, even if the absolute numbers are huge, Wall Street's going to reflect that. And so I guess to answer your question, I think there has been a pivot point there. There's an awareness in the public. I think there's a certain awareness on politicians' part. We'll find out. And I think Wall Street is responding to that, and will continue to respond to that if they see that the trend is to reduce government spending and move in that direction, okay? The numbers, absolute numbers, are still going to be awful. It's kind of like a stock that comes out of 2008, 2009 that's got terrible numbers, and then they report a quarterly profit that's a huge loss, and the stock goes up 10%. The reason being the loss wasn't as bad as people thought. And I think that's how Wall Street's going to perceive that. I don't view the stuff on the political scene right now as a negative for stocks. I'm not sure I'd put it in a real big bullish camp, but I don't see it as a huge negative right now. I think there's an awareness there. I think the markets recognize that, and I think there's a potential pivot point. I could be wrong about that, but that's kind of how I view that. Yes?
We have time for one more question.
Yeah. How do you think the housing market is, with all our foreclosures, are going to affect the stock market, or are affecting it?
The question was, how do I think the housing market's going to affect the stock market? I think the stock market has become so comfortably numb to a lousy housing market that it's somewhat irrelevant to stocks. I mean, because it's been bad for so long. I think if there's anything that happens on housing that will affect the stock market, I think it's going to be a positive and not a negative, because I think they've discounted the fact that it's bad. Okay. The other thing to keep in mind too, that's such a the housing market is kind of a broad statement, and there's a lot of, it's all about geography, although you could make an argument most everybody's stuff is down. But I don't think it's going to negatively affect stocks, and if anything, if you get any inkling, the expectation level on housing is so low right now. Again, the hurdle's so low for it to beat in terms of beating expectations. So